Thank you. Uh, Good afternoon, everyone. Since the morning, you have heard a lot about AIF structures and strategies. Now, it's time to sort of get into the details and nitty-gritties of AIFs. As of now, there are about 268 AIFs which have registered, and there are several more which are in the application process. A lot of those 268 AIFs are divided into different categories, both 1, 2, and 3. Some of them are functional, some of them are at fundraising stage, some of them have already invested and started their second or third fund. We have an eminent panel here, so let me sort of do a quick check in terms of what kind of funds they manage, what kind of strategies they use, and then we'll go from there. Vineet, can I start with you? Can you tell us a little bit more about what kind of fund you manage and what strategy you operate?
Sure, BD. So IFMR Investments today manages Category 1 and Category 2 alternate investment funds. We operate in the fixed income space. We seek to take medium to long-term bets in specifically in the inclusive finance space. Now, why inclusive finance? Because we see this as not an area that requires charity, but as an opportunity where there is a possibility to build a significant competitive advantage by taking bets in companies that may see several rounds of growth, equity infusion, rating upgrades as we go forward. We operate in sectors such as SME finance, affordable housing finance, microfinance, used vehicle finance, agricultural finance, and so on. Typically, our funds are around anywhere from 5 years to 10 years of tenure.
Okay, thank you for that color. Saravanan, can I check with you in terms of what kind of funds and strategies you look at?
Sure. In Unifi Capital, we have two platforms. We run equity PMS, and in the AIF side, we run a Category 3 fund. We're focusing on event-driven arbitrage opportunities and fixed income debt. And our objective is to generate, at this point in time where the taxation stands, our objective is to generate a post-tax return of 10%, and with our standard deviation of 8% or less. So that's the mandate we have sought from clients.
Okay. Prashasta, how about you?
So at IFL, actually, we manage AIFs across all categories. So we have Category 1, Category 2, and Category 3 AIFs. We actually run multiple strategies. So we have fixed income AIFs, we have real estate lending based AIFs, we have long only AIFs, and we have actually event arbitrage kind of AIF. So we have a presence across all categories and all asset classes in terms of AIFs.
Okay, thank you. And Nalin, how do you look at your funds?
Okay, thank you for having me on, BD.
Thank you.
At Edelweiss, we manage, again, a range of AIFs. We have a Category 2 fund that does high yield. We have a fund that does stressed assets. But the funds that I manage are focused on alternative equities and specifically equity long short. We manage two funds in particular, one that has a more long only and long-term focus, and one that has a more debt-like orientation in terms of its risk-return profile.
Okay, so when we talk about these three categories, 1, 2, and 3, and there are several players, each has their own USPs. A common question which a general investor, and being a high ticket size, anyway you will have a little bit more sophisticated investor than the normal retail one. A common question which comes across is benchmarks. What kind of benchmarks are we looking at? How do I compare these AIF returns, promised, guaranteed, or forecasted, whatever you call it? Where do I compare? Where do I draw the line? Can I compare them with so-called hedge fund returns or hedge fund indexes out there in the world? Can I compare with the normal passive investments, which are ETFs or mutual funds, which so-called are outperforming on an average? Nalin, can I have your view since you manage more on the listed side?
Yes. So BD, our experience has been that for an alternatives business to be successful, it's got to have a reference in a traditional asset class. So as I mentioned, we have two long-short funds. The first has a more long-term orientation and is long biased. And for that fund, the benchmark is the Nifty. Okay. For our lower risk long-short fund, which has more of a debt return, risk-return profile, the benchmark is CRISIL Liquid. But in both cases, clients expect us to deliver a meaningful absolute return over any invested cycle.
So it's looking at absolute return, not a relative return.
Yes, but the funds do have benchmarks so that there is a frame of reference for clients and investors.
Okay. Prashast, at least in mutual fund side, I've seen that, even though your fund is investing, let's say a BSE 200 or BSE 500, a lot of times people have irrelevant benchmarks, which is, let's say, a Nifty 50, because it's so commonly understood, or a Sensex, right? How does it work in your category 1, 2, and 3?
So obviously, Nifty is a relevant benchmark only if you are doing long only AIFs. So
Yep.
for category 2, depends on what kind of investments you have. But let's say if it's an unlisted equity, then I think people are looking more at traditional private equity kind of returns rather than a Nifty based kind of returns. So Nifty kind of becomes relevant only in long only category 3 AIF equity that you are doing. And there I think, Nifty being a benchmark, I think is, what people look at. But end of the day, I think from an investor point of view, people look at returns vis-a-vis other investment avenues that they have. So for example, I think investors at some point will compare your returns with what they could have got in mutual funds. And will try and see whether they have been kind of better off by sticking to you, or they could have kind of gone into a mutual fund where they would have maybe a lower ticket size and maybe an easier liquidity environment. So I think, so to that extent, I think benchmarks are there, but each product will have a specific attribute and something that you will go and kind of tell the investors when you are doing that particular product. And I think investors will kind of look at from that perspective on how the returns have been vis-a-vis the expectations, and also vis-a-vis the other alternate avenues that are there with respect to investments in those particular asset classes. So to that extent, you have benchmark, but they are not
Not a whole
that
lot.
relevant.
So you're saying inherent bias is there comparing with other asset classes, which is mostly mutual funds. Saravanan, on the debt side, the common questions the investor asks is, okay, what am I getting in FD or a fixed deposit? And what are you giving me? How do you tackle that part? Where is your benchmark?
Essentially, we are a multi-asset class fund. So we use equities to do special situations arbitrage. We use debt to get high yield. And so our benchmark is actually fairly very simple. It's absolute return oriented. So 10% post-tax is the benchmark. So every year, we need to generate that across economic cycles. So the underlying philosophy is, for every unit of market risk we are subjecting the investor to, we should be able to generate more than 1 unit of return. So that's why when I said 10% post-tax, the 8% or less standard deviation. So that's the benchmark. Having said that, invariably, we get compared to a dynamic bond fund or a short-term bond fund.
Okay. Vineet, on the inclusive finance side, typically, obviously, there are no benchmarks because there's a bit of CSR, developing the sector itself involved. Do investors take a hit in terms of how they measure benchmarks in such cases?
So that's the thing. We are not seeking investors' money for either CSR or muted returns in that space. We're not a social venture AIF.
Right.
We are a very commercially oriented organization. At the end of the day, we need to deliver returns that are superior to the market. A closest comparable to what we do, although it's not really a published benchmark, is credit funds run by mutual funds, which we need to beat by at least, I would say, 200 plus basis points for our offering to be meaningful. What we have tried to do over the last 2 to 3 years is to try to orient this to how a fixed income investor would look at a structured finance product. So for example, we add a layer of credit enhancement in what we do to reduce risk. We try to bring an incentive alignment. We try to use diversification. We try to use tools like this so that the investor's mind is more oriented towards comparing this to a credit fund than to, say, for example, a real estate fund, right? So that's the objective. Having said that, we are really hamstrung by lack of really comparable options in the market. We keep getting compared to real estate returns, but at the end of the day, we are nowhere there in terms of returns. At the same time, the objective is to hit the middle line in terms of returns and safety. So we actually rate our funds as well. So that's the rating
When you say
framework
rate,
is
are
not-
these credit ratings or?
Unfortunately, no, because the AIF rating framework is a little different from credit rating. But that's again part of our effort. It's part of our advocacy effort to try and bring this as close to a credit rating as possible to make it very comparable.
So AIF, the technical framework, I think, came in about 3 or 4 years ago. Yeah. So we don't have a long history in terms of performance, and there are very few funds who were there at the very beginning. However, whatever history you have seen in terms of performance, how are those challenges? I mean, in terms of when you look at investors, so maybe if a pension fund is investing in your fund, he's maybe looking at a different time horizon, so he's okay with the illiquidity which your investments might offer, whereas if the HNI is looking at, he might look on QOQ or year on year. Where do you see those challenges? Do you see some of those institutional money where liquidity and these kind of challenges come through?
So we're one of the fewer AIFs that has substantially focused on institutional money. So pretty much 90% of we've raised around $100 million so far.
Okay.
90% of that is institutional money. So it's coming in from very, very large investors with ticket sizes of anywhere from the lowest is 10, the highest could be 50 in terms of ticket size. So from our perspective, these guys are in for the longer term. Although we have tried to give them a sense on a monthly basis on what they make, or on a daily basis in some cases. But they clearly are there for the longer term. We haven't really seen pressures of exits and requirements for secondaries. We have seen some, but it's not. But by and large, the investors are in for the longer term.
So this is possible where cases where you have loans which are repaid daily, and hence you are able to measure something. But otherwise, it will be just a valuation game because
valuation
it's
coupons,
a notional valuation.
At the end of the day, but valuation is much easier if it is in fixed income. There are comparables available in the market. Even in the space that we are in, which is the less liquid, less understood space, today it's on account of, in a way, our own work, it's getting better and better known and with much better comparables in the market.
Prashasta, how is your investor base looking into the three different categories? I mean, category 3 obviously is more liquid side, but how about category 1 and 2?
So we, all our funds are typically closed-ended, and they have a time frame attached to that. So which could be, for a category 2, if I'm doing a private equity fund, I think that could be, maybe 7 years. A real estate lending or a fixed income could be, 3 to 4 years. So I think every fund has a life cycle and a maturity which is attached to it. And from that perspective, you try and kind of get investors who look into that instrument from an investment point of view with that kind of a time frame. So to that extent, obviously things come from time to time in which people have certain liquidity requirements, or they need money, or they want to get out of some investments. But we haven't kind of seen any big requirements till now. I think most of our investors have been kind of fairly patient. They have been willing to kind of invest through the life cycle of the fund. And I think since the fact that they have come in with a particular time frame in mind, I think that makes them a lot more comfortable with that, rather than kind of looking to exit at any point of time.
Okay. Saravanan, with your kinds of fund, is there a pressure on performance from institutional investors or retail, whatever you talk about?
So at this point in time, if you see our investor base, it's typically HNIs and family offices. Yeah. As I told you, we work on an absolute return benchmark. So typically our clients tend to measure with the mandate that we have sought from them.
Is this more yearly?
Yeah, it's yearly. So yearly 10% post-tax is what we have committed to deliver.
Okay.
So that's the thing. But in terms of institutional, if you see as it stands, there are some conflicts that we have to address. So for example, CPF RDA allows investments in Cat 1 and Cat 2.
Right.
In fact, it would also make sense for them to allow in Cat 3.
Cat 3.
Although they say we do leverage, we do F&O, but if you see, we are an open-ended fund. So we are completely transparent in terms of valuation, in terms of the securities that we hold. And even for a pension fund, which has periodical inflows, it makes sense to have access to an open-ended fund structure rather than a closed-ended fund structure.
Okay.
So once that opens up, we feel the institutional money also would start flowing into Cat 3 funds.
Okay. Nalin, you have spent some time looking at US and other markets as well. Before the AIF structure also, there were a lot of these VCNP framework which was in place. Of course, we haven't seen a sort of tide turning out kind of a situation in AIF cycle where investors really scramble for their money because the markets are so bad or the investments are not doing well. Right now, we just about 3 or 4 years. So a lot of funds which have started after the AI framework, they have not even completed half midway to their life cycle. But how about sort of when the tide turns away, what happens then?
So I think there are two things that are pertinent to note, actually, BD. The first is that all AIFs have a 1 crore minimum.
Yeah.
So in some way, you are asking you're soliciting investments from investors that are fairly sophisticated. You
Right.
don't have, a large base of retail clients. And then the second is, at least within a category 3 context, the regulator has been very prudent about the leverage that they have allowed.
Yeah.
And I think that by and large, when I look across the industry, funds are being managed in a prudent manner. And the industry itself is fairly small. Today we have a long way to go. Category 3 funds total about 5,500 crores in assets, which is a drop in the ocean compared to the mutual fund industry, which is at 16 lakh crores. So I don't think that at this size and given the constraints that there will be any kind of systemic risk or liquidity event.
Okay. But generally speaking about category 3, even though it's not a regulatory subclassification, the way the funds are structured, they've sort of kind of divided themselves into 2 different ways. One of them are more manager-driven funds, which are more discretionary fund. Others are more platform-driven fund, where they have some money which they're collecting for investing in an idea. Where do you stand in that category? And within managed-driven fund also, you have people who are just long only listed equity or unlisted equity, people who take F&O or some sort of a leverage.
So we are focused on manager-driven funds because I feel that has more enduring value from an asset management business perspective. But we would consider even some of these thematic ideas at the right time and with the right idea.
All right. Prashasta, there's been ongoing debate about this whole performance fee structure in different funds. I mean, globally, you have this whole acronyms 220 or so many things. The AUM fees typically is getting down. Robo-advisory is coming in way. Last week we heard a speaker which said that if it's a human intervention required to advise, then it's about 1% for AUM. If it's a robo-driven advising, about 0.25 basis point. AIFs do require a lot of active management and involvement with the sort of subject company to a large extent. Are the fee structures also different in these 3 categories?
Obviously, Cat 2 and Cat 3, I think, will be different because Cat 2 will be unlisted, and to that extent, I think your ability to charge a private equity kind of fees is much larger, or a profit share is much larger in Cat 2 than, let's say, in a Cat 3. I think the Cat 3, the big challenge is that people always will compare yourself with the fees that they are paying for mutual funds, and now with the direct code coming in as well. So they have kind of multiple options on the mutual fund side. So I think your fees as a combination of fixed fees or a profit share, I think has to kind of in some way be competitive vis-a-vis what people are going to give to the mutual funds. And I think that's where I think a clear comparison is being made by an investor when he is investing. And I think the general notion is that if they are committing larger amount, I think the fee structure has to be really, really competitive, or maybe even kind of a lower than what they're going to give in a mutual fund. So to that extent, I think every strategy or a Cat 3 would require a lot more structuring, if I may say that, in terms of what fees you are charging with respect to, let's say, a fixed fees or a performance-driven fees. Then let's say a Cat 2 or a Cat 1, where your ability to charge, higher fees and higher profit share is much stronger.
Saravanan, how about your fund side, where you have absolute, benchmarks? Are the fee structures same?
Yeah, we follow the 1 and 20 model. So once you establish consistency of performance across market and economic cycles, actually clients don't mind paying us such a fee. So we don't see any risk to that as long as we are delivering our mandate.
Okay. Vineet, you mentioned 90% of your investors are more institutional. Are there different fee structure for institutional and retail segment in some of these AIFs, or are you fair to all investors? Technical question.
And today we've kept it simple so far.
Okay.
It's a single flat fee structure as on date.
Okay.
As I mentioned, we have largely modeled ourselves around the MF industry, and which is why we kept our fee structures very simple. As on date, it's a simple flat fee.
Okay. It's for everyone who's ever.
Pretty much. Same fee for everyone.
Okay. Okay. All right. So let me sort of move towards the close and check with each one of you in terms of what are the top challenges which you're facing in the respective AIFs or the segment which you follow. Vineet, what would you rate the top 3 challenges about the AIF structures?
So I think from our perspective, there are 2 areas which we've been advocating for a while. The first is under SCRA, and AIF unit is not a security, and that prevents listing. We feel that transferability will be much more enhanced if AIFs can be listed. And this is linked to also getting a lot of foreign inflow into alternative investment funds as well, where today some of the language around taxation is not entirely clear. We've been struggling a little bit on how the pass-through really works, how much is withheld based on the geography that money comes in from. And yeah, so I think these are some of the challenges, and listing will clearly, I think, make an AIF unit much more attractive for both Indian institutional as well as foreign institutional investors. The second is slightly confusing categorization when you look at offshore money, about the fact that a foreign portfolio investor may only invest in a category 3 AIF. Now, the reality is that there are today a whole host of such investors who may have an FPI license but are not doing much with it, and today therefore are restricted from investing in a pooled vehicle onshore simply because they hold an FPI license. It doesn't necessarily make sense. So these are, I would say, some issues we are facing on the, I would say, on the fundraising side.
Okay. Saravanan, 3 challenges apart from taxation.
Yeah, apart from taxation, see, one of the IPAC committee recommendation is to introduce the concept of accredited investors.
Accredited investors.
So they don't have to really do the 1 crore investment. So
Yeah.
25 lakhs and above, or even based on their income, they should have access. Even many of the IFAs have told us, we like your product, but
The ticket size
the
is too
ticket
high.
size is too large. So why not have a lower ticket size? So that's one. So that will be really helpful. And again, coming back, see, insurance funds and pension funds are managed by professionals. All these companies have professional teams to do due diligence, investment appraisal, and monitoring. So if that be the case, the regulators should not undermine their capabilities by having a restriction that they should not look at Cat 3 or they should not invest in Cat 3.
Right.
So they should be open. They should
So
open
more
up
fund
to Cat
managers
3.
and Prashant, how about you?
Yes, I think apart from the issues that have been highlighted, I think from a Cat 3 perspective, I think there are 2 challenges. One, I think there's this whole guideline that came in with respect to foreign investment in Cat 3, I think is fairly confusing, and as a result, you have to potentially kind of structure two AIFs, one for resident Indians and one for non-resident Indians. So I think that clarity from a Cat 3 perspective, is important. So for us, the problem comes is because we are a foreign-owned entity, because we have more than 50% stake held by FIs, and it just creates a whole lot of complexities in kind of getting foreign money into Cat 3 AIFs. And I think the second is, I think from a Cat 3 perspective, I think, as has been mentioned, I think in the report that is going across, I think it will be prudent to kind of subdivide it into 2 categories. One is long only and the other one is more hedge fund type. I think, Cat 3 kind of encompasses both long only product as well as a hedge fund kind of a product. So I think a clear distinction between the 2, if it happens, could be obviously beneficial for scaling up the businesses.
Okay. Nalin, final vote for you.
I think the thing that everybody is really waiting for is complete tax clarity. I think that is the big catalyst for this space to grow. And I'm hopeful that some of the AIPAC recommendations around pass-through taxation and STT-based taxation do get heard and implemented in the budget next month. But fingers crossed.
Yeah. Well, APAC 2 reports recently, I think they closed their deadline for submitting comments, but essentially it talks about a lot more clarity, a lot more disclosures, a lot more benchmarks, performance, and availability of data to general investors. As we stand now, I think the total commitments raised by AIF is about 65,000 crores. And globally, the estimate is that AIF money will eventually reach to about $18.1 trillion by 2020 from versus $10 trillion right now. So we are really looking for 100% growth over the next few years, and hopefully that will resemble to markets like India as well. Thank you very much for your time today and the wonderful discussion. Thank you.
Thank you.
Do we have time for questions?
We can take questions.
We have time for a few questions if any of you wanted to ask. We have a mics around, we can pass on. And if it was too clear, then, we're okay. All right, sir. Can you pass on a mic there to the gentleman?
I have a question to the person on your
Nalin.
Nalin.
Okay.
That in your long short fund, how do you deal with the events like Brexit or the Trump or Grexit and such events? How do you manage risk in such situations?
Or demo.
Right. So we look at companies really bottom up, and we aren't as macro focused. And largely, the long short funds have a lot lower risk than a traditional long only portfolio, because you have some element of natural hedging between your longs and your shorts. So we tend not to worry too much about events that we really can't control, and focus on understanding things that we can control or know.
Thank you.
Okay.
Can I just ask one?
Sure, go ahead.
I think a couple of you did mention that you, the quasi benchmark that you consider is either a credit fund or a dynamic bond fund. Now, inherently an AIF is at a disadvantage versus a mutual fund because of the underlying trust structure in mutual funds and no trading gains, income, etc. So how do you manage to beat your performance adjusted to the cost and the inherent taxation to the end investor?
So we'll have to work with the current tax structure. So as you would know, mutual funds all the debt funds have gone on a 3-year in order to get the long-term capital gain advantage. So CAT 3 is still open-ended, and taxation, as I told you, we are working on a post-tax structure. So it's actually, at this point in time, there's kind of an arbitrage. If somebody has 1 year or 2 year money, it makes sense for them to earn 10% in an AIF rather than in a mutual fund structure. And having said that, I also told you, like, we are trying to generate 10% across economic cycles. And then, but IFAs tend to measure us with the dynamic bond funds or short-term bond funds. For us, the benchmark is the absolute return. But we tend to get benchmarked. So,
Yeah. All right, one more question. The gentleman in the blue shirt.
Hi, I'm Anand from Sundaram Asset Management. So regarding category 3 funds, when there is an NRI investment, so there is a restriction by RBI, in terms of investing in a money market instrument or a, liquid mutual fund. So there is, again, at least there's a lack of clarity. So how do you manage this kind of challenge? Like, when you get drawdowns, so you can't keep the money idle in a bank account. So you have to, deploy in some short-term instruments. So, so practically, is there any solution to handle this? Any workarounds?
Prashasta, you want to take that?
So I think either you do it in kind of fixed deposits, or you have, you identify instruments which you think are kind of compatible with the guidelines that RBI has. So there are some instruments which, according to us, could kind of comply with the RBI guidelines. So we kind of do that. So we haven't, at least as yet, kept any money which is idle. So we've been able to find avenues which, according to us, meet the RBI guidelines.
Okay. And the second question is about the US and Canada persons. So that's again a bigger question. Even the MFs face this issue. So, do you find any difficulties or, practical issues in accepting US and, Canada persons as investors in AIF.
Do you have any foreign investors in any of your funds?
Not yet.
Sorry.
So you don't accept US and Canada investors?
So we actually have US and Canada investors in our AIFs, but as I said, so we actually have NRIs, and obviously there are guidelines in terms of that NRIs have to be there when the signing of account is happening and so on and so forth. So we have kind of taken some processes and systems in place so as to ensure that the sale of the instrument is not a US or a Canada. So we have some exposure of NRIs through that, but we haven't kind of taken any exposure to people of foreign origin. And
all right, thank you very much for the panel and for the questions. Over to you, Sonia.
I'll request Mr. Biharilal to please felicitate our panelists.
Okay.